in 2011, a senior person at UBS was at a conference and stood up and said, the person or firm that solves the credit risk in structured notes will have changed the industry. And that was, he issued an open challenge to the industry. And I remember me and my co-founder was like, challenge accepted. That's what we're going to do.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Hey, welcome everyone to this episode of the Bull of Wall Street. And I'm excited because today our guest is my good friend and buddy, Jeff Chang. We love going to conferences together and changing badges, putting on some sunglasses and acting like we're each other. Anyway, that's a lot of fun. So for those of you that have not listened to this or seen this podcast before, my name is Jimmy Lee. I'm the CEO of the Wealth Consulting Group, and my co-host here is Jim Warden. He's our Chief Investment Officer. Our other co-host is not with us today, Tally Leger, Canadian guy. He's on the road working. And so it's just going to be us two and our guest, Jeff Chang. I know that a lot of financial advisors know who he is. We were just talking about how often he's on the road doing what he does. But for those of you that don't know Jeff, he is the president and co-founder of Vest. And currently, I think I asked him this morning, they manage around $45 billion in ETF money. Is that about right, Jeff?
Yeah, across all our products. That's right.
Yeah. And I know that's grown a lot in the last 5 years. Crazy growth. I think Jeff said just a minute ago that he traveled like a couple hundred days last year, was on the road, which is insane. But and so today's topic, unlike some of the other guests that we've had on, we're going to cover various topics, but we have a lot of people that are on that talk about markets, and we'll get there. We're going to ask Jeff. Jim's going to ask Jeff about the markets and things like that, and innovation, in industry, stuff like that. But we're going to start out talking about, being a founder of a company, entrepreneurship, and go back and forth on that. And before we go there, Jeff, maybe you can help us with just kind of your career, how you've gotten to where you're in now.
Yes. And thanks guys for having me. It's been an honor to come on. I've listened to all the episodes, so it's great to finally be on. And I feel like I'm in really good company, and I'm flattered for the invite. So thanks a lot to the both of you for having me. So let's see. When I started, I actually went to school at the United States Naval Academy, then business school at Georgetown. Actually did not major in finance. In fact, when I graduated, I actually tried to start a flat screen TV import export business. That's how much I wanted to be out on my own right after I graduated. And then in fact, if you look at some of the TVs back in the day at Reagan National Airport, right there in DC, a lot of if you were looking for arrivals and departures, those were actually created by me back in the day. But then it became very, very difficult to do. I realized even doing the financial statements for my company was tough. And so I knew that I had to get a lot of actual tangible skills. Because if you notice, in college, a lot of it is if you think about your work today, a lot of it you probably didn't learn in college or even in business school for that matter. You actually learn on the job. So I realized I had to, really kind of get a tangible skill. So I went back and I remember I eventually started working at the World Bank, translating Chinese financial statements for coal companies in mainland China. There were two problems, though. Number one, I couldn't read Chinese. Number two is I didn't know the accounting. So I went to go solve one of those, and I just went out and signed up for a CPA review course. Wasn't even a major in accounting major. Back in the day, you didn't have to be an accounting major. So I just took, all 4 parts of the CPA exam after taking a review course and ended up getting my CPA. So I am a recovering CPA, which I still think stands for can't pass again. But that was when I kind of went into more kind of tangible skills. And then I found out with the CFA program, I know I wanted to be more in finance. I ended up moving over to a company called Freddie Mac, doing mortgage trading. And I realized I needed a little bit more in finance. So I took the CFA program, really loved that, was able to apply that a lot of, on the trading desk, understanding markets. So, by the way, this was like mid 2000s, right? Being a mortgage trader. So you can kind of do the calculation. We're slowly getting further along in the mid 2000s. And then I ended up moving over after getting my CFA charter, ended up going over to a company called FBR, Freeman Billings and Ramsey, where I worked on their buy side principal investing desk, which traded mortgages. And I know, Jimmy, you just came back from the Phoenix Open, right? I think it's now called the Waste Management Open. But for those people out there that know what it was before the Waste Management Open, it was actually called the FBR Open, right? That was the investment bank and the trading desk that I used to work at prior to becoming the Waste Management Open. And so I was trading mortgages in the mid 2000s, and then 2008 hit. And I remember September of 2008, I was trading buy-side mortgages. And I remember getting margin called, and literally what you see on TV or in movies, I was living that in 2008. In fact, there was an article back then. I was repoing agency mortgages, and Lehman Brothers was my repo counterparty, and they took my bond. It was supposed to be collateral. They just sold the bond.
Wow.
And they were like, well, just try to find it in bankruptcy court, right? And by the way, I had already sold the bond to a Japanese bank at the time in September of 2008, and Lehman had actually sold my bond, even though it was collateral, had sold it off. And so it was a crazy time. I remember working till like 3 a.m. Many times during that time, and being in your 20s, it was really formative as far as like being a trader, and even really formative as far as building my firm and how we think about product and thinking about tail events and so on and so forth. And then it wasn't a great time to be a mortgage trader in 2008. So in 2000, and I think a couple of years later, 2009, 2010, I cut over to the convertible bond and option desk, right? And then do it in that time frame was on the sell side desk. We had a sell side desk in New York, and I spent some time there. And that's really where I kind of really cut my teeth in options, right? And by the way, if you do the math, once again, in 2010 was the flash crash. And if you can imagine an option trader, sell-side option trader, we couldn't go long volatility fast enough in the middle of the flash crash in 2010. And so that was also very formative. Having experienced the 2008 crisis September, the May flash crash in 2010, and then so was on that option desk for a bit, and then had a brief stint at ProShares. That's where I met my co-founder, and then B, where I really learned about kind of the emergence of exchange traded funds, ETFs, where I actually really started to learn about 40 Act funds. And the way we thought about it was a lot of the trades that we do on the institutional side with banks, we could actually package them into 40 Act products, right? And I can tell you, this was the source of how we started. So that if you look at the buffer space today, right, it's almost 100 billion in assets. We were the first company to actually file for 40 Act product in 2012. We quit our jobs to do this, and in fact filed a patent. And in some cases, we even went to, because you can't patent. By the way, there was like a Supreme Court case. You can't patent financial products. So what we did was we ended up going to S&P and licensing our IP and then they gave us a 4-year exclusive on our strategies, right? Meaning they wouldn't allow other people to do, let's say, a 10% buffer out there. By the way, later on, you'll see a lot of the competitors came out with a 9% buffer to get around the exclusivity. If you've ever seen Something About Mary, it was like 8-minute abs versus 7-minute abs, like two squirrels on a branch, sitting on their father's ranch, kind of, if you ever seen Something About Mary, totally that situation. So that was the first time we ever filed. And the reason why we actually pursued this was actually in 2011, a senior person at UBS was at a conference and stood up and said, the person or firm that solves the credit risk in structured notes will have changed the industry. And that was, he issued an open challenge to the industry. And I remember me and my co-founder was like, challenge accepted. That's what we're going to do. We are going to fix the credit risk in structured notes because during that time, the credit component was really fresh because in 2008, the largest issuer of structured notes was Lehman Brothers, right? As you know, a note is an unsecured debt borrowing. That's why at that point it was credit risk in notes was very, very kind of top of mind at that point. So that's why we kind of pursued to try to create a 40 Act fund with no credit risk to have these types of solutions in there. And that's kind of what spawned it. Now, obviously, we had to raise capital, right? So this is where I think it was a little bit unorthodox on how we started was we joined a startup program called Y Combinator. And if a lot of listeners out there have not heard of it, it is the #1 startup program in the world. I think over 30,000 people apply a year and they accept less than 1%. And essentially, I think the statistic is it's harder to get into Y Combinator than it is to get into Harvard. Meaning, whereas if you go to Harvard Business School, you're going to pay $250,000 perhaps for your education. In the case of Y Combinator, they pay you, I think today, about $500,000 to start your own company, right? The companies that have gone through this program, I think many of the listeners here have probably heard of them: Airbnb, Dropbox, Reddit, Coinbase, DoorDash, Instacart, Twitch. I could keep going, like Stripe, Cruise, like all of those companies had nothing. And just like us, applied to that program, got an injection of capital, went through the program, and then started. So I always like to joke, like, Buffer Funds and Airbnb and Coinbase all came from the same source, right? That innovation and that type of innovation had really sourced from the same spot. So that's how we actually got our start, and kind of my background on how we got kind of just in the very first part of our journey. And I know, Jimmy, we talked about this as far as like, what it takes to actually be kind of a founder and really kind of trailblaze and grow companies, right?
Yeah. I mean, that was 2012.
That was, 2012 is when we started. Yeah.
And exactly. That Y Combinator deal, I'm assuming they take an equity stake or something like that.
Yeah, I think the current deal is, if I'm not mistaken, it's about $500,000 for 7% of the company.
Wow.
Right? If you look at the total valuation of all the companies that have gone through the program, I think it's over 600 billion in market cap. So that if you look across, there's the second place is not even close.
So you and your co-founder didn't come from wealthy parents that wanted to give you some money as a gift, huh, to start your venture?
Yeah, no. I mean, as you know, like, I'm a first generation. My co-founder is an immigrant from India, so yeah, that was like I went to public school, so that was like a huge thing for us to basically go through Wall Street. And he used to work at Barclays, so we both cut our teeth in New York. And on Wall Street on trading desks. He was a structurer. And then, decided to go the startup route.
So Jeff, talk about that last, let's say 12 to 13 years, from that beginning, to now, and really the company has taken off, right, in the last like 5 years or so in terms of asset growth. Is that right? Talk to us a little bit about that journey and how that happened. And then I'm assuming you guys went through a lot of, even though you got the funding from Y Combinator, I'm sure you had struggles raising assets into a very ultra competitive space. You decided to get into the ETF space. Talk to us about that.
Yeah, I can't tell you how many times that we almost died. So there was a time, I think I went 4 years without taking a salary. And
Wow.
that's how it is. Like, a lot of times people say, like, hey, I'm going to start a company. If I had to do it again, the answer is no. I'm not doing it. Because, like, it's almost an advantage that you don't know how much pain it is, right? It's like you're climbing a mountain, but there's fog. So you keep climbing and it keeps going higher and higher. That fog is actually extremely helpful, right? In the case of now, I actually sit at the bottom. I can see exactly how far that thing's going to go. If you ask me to do it again, that would be tough. But I think that fog really helps. And I can tell you that 4 years of not taking a salary, you're probably asking like, hey, how did you survive? Well, it's a lot of saving on your Wall Street bonuses. And I actually ended up taking up teaching CFA and CPA. And this is how Jim Ward and I
remember.
met. Right? Like when you were taking the CFA program, I remember speaking, this was almost 10 years ago, right? Like,
yeah, I think it must have been like sometime in 2011, 2012, because it was just Vest at that point.
Yeah.
And I think you guys, it wasn't ETFs yet, but it was like you had to have a custom contract for each one.
Yeah,
and
that's right.
then you're like, hey, Jim, can I help you with your CFA? Because I was studying the CFA at the time. You were teaching there.
He said you
grading, right?
You gave him some books for free.
Yeah.
You did. Yeah, you did.
A nice guy.
I know.
Yeah. And I remember that time because I also used to do the videos for Kaplan and Schreiser and teaching.
Yeah.
And by the way, that's a wild experience because you end up teaching all of the CFA students over the years. To this day, I still sometimes go to conferences. They're like, you're my CFA instructor. I was
You're
like,
my teacher.
Yeah. I was like, I have no idea who you are. They're like, my wife knows you. Right. And I'm like, you've been in my living room for 8 hours straight, like over like so many time periods. And I'm like, I've never met you before, but they feel like they like know you because, when you study for CFA, it's an incredible amount of hours. Right.
Yeah.
And so they just keep rewatching it in their head. They're like, I've spent, 10, 15 hours with you. Like, you're my best friend. I was like,
it's like you're part of the family.
Yeah, exactly. My kids like know who you are because I'm just watching these videos, but it was wild.
Oh, that's too funny.
How I kept myself alive was teaching CFA on the side, which was actually an incredible way to source your initial clients. Because the reason why is, and Jimmy, you probably know this, is that when you start an asset management firm or a wealth management firm, it's really hard for if you don't have a book that you're bringing over or like you have to find your first clients to trust you. You need a couple years of track record before you prove yourself, cut your teeth. No one's going to give you billions of dollars on day one, right? And you have to kind of plan for that runway. And this is true for any business, not only in asset management, but even in startups that in technology startups is like, planning for that runway and making sure that you personally, as well as the company, have enough runway to actually get escape velocity. But I think one of the best advices, though, that I can give people that are thinking about starting their own company is a lot of times people focus on the burn, meaning how much cash they have left and how much runway they have left. But instead of focusing on runway, the key thing is focusing on lift, meaning do whatever you can to achieve lift, growth, and profitability. Like if you're always focusing on the runway, like how much time you have until failure, that starts to kind of change the way you think about your business. The key is trying to get to escape velocity, profitability, and growth. So that way, you can perhaps raise your next round, or in the case of achieve profitability where you don't have to raise that next round. So I found that process to be extremely formative if I were ever to start another company on what's the grind and what are the things that you really want to focus on is really try to get to profitability and lift as quickly as possible, as opposed to saying like, hey, how much time do I have left through my runway?
I went without a salary for 3 years when I started the RIA, but I did have my personal practice that I always leaned on that had been around for a long time. And so I wasn't like eating ramen every day, but still starting a new venture, investing a lot of money, taking a lot of risk. In our firm, we're going to be doing something different too, starting this year and taking more risk again to try to grow and get to the next step. But Let's switch gears a little bit from the founder journey a little, and we can go back and forth on that. But buffered ETFs are really taking off now. So I know you could probably talk to us a little bit about just that in general, the space that you're in and that you kind of dominate now. But as far as product innovation, what do you see for the future, like for our industry?
Yeah, so I can take a step back. I think I tell a lot of my team that we're probably in the third inning of this product innovation, mostly in the derivative and option space, right? Some interesting facts that people don't realize. So there are, I believe, over 300 different kind of option-based ETFs out there and funds out there. And if you look in 2020, right, that I believe like option-based funds were ranked 56th in the Morningstar category, right? Just last year alone, the option space is 9th in Morningstar.
Wow.
Think about that. That's along with large cap blend fixed income, meaning if you're not looking at this space, you are basically just not even looking at something like large cap blend, right? This has become a major part of people's portfolios because I think it's the changes is that those tools, which traditionally have not been available in a liquid and credit risk-free form, are now available to investors today. Another piece of information, which is really fascinating to me, is if you dig a little bit deeper, that 72% of the actual, let's say take even derivative income, cover call funds, 72% of them were launched in the last 36 months, right? Meaning that if you pick up a cover call fund, I guarantee you it's no more than 3 years old, right? Hasn't even hit its 3-year track record. Secondly, 90% of the assets raised in this space have been raised in the last 36 months.
Wow.
Right. And then the last thing I'll say is, which is even more interesting, 90% of the assets, let's just say in the cover call space, is in 10 ETFs, right? While there are over 300 of them. So it is a very fast growing space, this option space. And I think mostly because if you look at the survey created by Cerulli Associates, the two biggest things that advisors and their customers are looking for, number one, income. Number two, downside protection. And think about, those are the things that options and derivatives can actually provide, right? Because I think the shift is that, let's just take income, for instance, that volatility is actually an asset class. You can monetize volatility. Just like you can monetize, I could create income off of the volatility of gold. I can create income off the volatility of Bitcoin, right? Because if you think about volatility, is just uncertainty, right?
Sure.
And when you think about uncertainty, think about this. Warren Buffett, one of his biggest positions is what? Geico, selling insurance, right? And options are basically the same thing. In fact, 70% of the time, the person selling the option wins. Because why? You have a historical view of what, let's say, the movement of the option is. Or if I'm selling car insurance, I have a historical view of what is the probability that Jim will get in a car accident, or what Jimmy will get in a car accident. I know the expected loss. And so if the expected loss, let's say for Jim, is $100, I'll sell the policy at $120. I'll get $20 of income. This in option land is called the implied versus realized premium, right? In the case of Jimmy, if his expected loss is $800, comparatively, then I'd probably still sell for $1,200 because he's high risk, right? That is also the implied versus realized premium. But that's why selling insurance has been so attractive, especially for someone like, Warren Buffett, why he likes it. Options are the same way. You can monetize that volatility to generate returns. The second is you can actually buy insurance, providing downside protection, right? And I'd say why we've seen kind of an explosion in the 40 Act space of, let's say, buffer ETFs as an example. Like we have gone basically from, I think 2 years ago, 12.5 billion to 45 billion in assets.
Wow.
A lot of it has to do with people are seeing the usage of downside protection, especially in the context of, let's say, the challenges we've seen in 60-40, right? Like Because as interest rates go up in inflationary environments, we've seen what stocks and bonds go down at the same time. Like in 2022, you had nowhere to hide. If you could have mixed stocks and bonds any way you want in 2022, you were down, right? You basically were like Tom Brady trying to figure out whether you want to pay child support or alimony as you're marching to your jujitsu class where your wife is, right? Like either way, you're in pain. So why not provide, and this is what we've always talked about, is diversify your risk management, right? Because the great thing about options is just like car insurance, your put option is perfectly negatively correlated to S&P. Once it goes bound and strike, it'll pay you 1-to-1, guaranteed by the clearing of the exchange. Just like your car insurance is perfectly negatively correlated to your car, right? Your life insurance is perfectly negatively correlated to your life. But in the case of buffers, that allows you to take the idea of correlation between stocks and bonds out of the equation. Because why? The foundation of diversification and asset allocation is I hope my stocks go down. I hope when my stocks go down, my bonds go up. But now if you're in a new paradigm where stocks and bonds are both going down, where do you hide? And I'm not saying that, I'm not saying that 60-40 is broken, but it should be supplemented with actually hedging, right? And that's where we're seeing massive.
Yeah.
So I got a question about that, but before I do, I want to make a comment. For those advisors that are listening in or watching and you have not seen Jeff yet, typically at our first trust due diligence conference, you got to go because the Tom Brady jokes that the one that he just busted out, he's got about 4 or 5 of them that are even better. He's a great presenter. In fact, anyway, I won't go there, but where do you think the buffered product fits in an asset allocation? Because most financial advisors, we're out there, mixing it up between equities and fixed income and maybe alts and cash. Where does it fit, do you think?
Yeah, so we actually built indexes in partnership with our one of our larger equity holders, CBOE, which is the largest option exchange and the creator of listed options. The same team that creates VIX, the CBOE Volatility Index, also creates our target outcome indexes. Now, if you look at, let's say, a 10% buffer of that index, and you go all the way back to 2005, you'll notice like the standard deviation is actually really close to a 60-40 portfolio. So I get a lot of questions is like, hey, where does this fit? Well, it kind of fits if you could take 6 from equity, 4 from fixed income, and you put it in, let's say, a 10% buffer on S&P, your volatility, your portfolio will be very similar, but the source of your risk management has changed, right? In fact, if you had done this, if you look at the strategy, like let's say a 10% buffer on S&P, and you look at it in the last couple of years, you actually dramatically outperformed a 60-40, even in last year with less volatility. The reason why is, think about this. In 2022, you did not participate in the majority of the losses, right? But in 2023, 2024, you also participate in the majority of the gains, right? It's winning without losing. You're essentially playing offense and defense at the same time. Why is Ohtani so good? It's because he plays offense and defense at the same time. Because even today, if I priced even like let's say a 15% buffer for 1 year on S&P, I mean, you could probably get something like 14% upside or something like that. I would give my firstborn child for 14% return this year. And in some countries, I can only have one, right? By the way, I don't have any kids. None that I know of. But just so you guys know out there, if I were to have a son, I would call him Paul Francis. So that way he could be P.F. Chang, and I could eat free lettuce wraps every day.
I love it.
That's my man.
So I got a question for you, Jeff. So thinking about using equities and bonds as a proxy. So what do you think of, I think it's Buff D, right? The deep buffer.
Yeah.
I feel like that almost feels more like a fixed income proxy.
Yeah.
Like
so that
you
runs
use that more for fixed income than for equity, right?
Yeah. So a lot of times people do, because think about it, like Buff D or Buffed, by the way, how awesome that is ticker, Buffed, right? You know what I mean? Like you're going to need like a good plumber because your pipes are going to burst kind of situation. But anyways, Buffed, right? Think about the risk return characteristics. Let's just take the ag, right?
Yeah.
The ag has like a 6.5 duration, right? So interest rates go at 1%, you're down 6.5%. In 2022, you're down over 15%.
Yeah.
By the way, back then, what were you chasing? You were chasing a 3.5 yield while inflation was 4,
Yeah.
right? You were losing money extremely safely, right? Think about that for a moment. But then I counter that with like a buff D. You're getting like over 12, 13% upside capture, like 12, 13% upside cap. And if S&P's down 30%, you're down 5%.
Yeah.
Right? Think about the risk return trade-off in the context of inflation. And so, yeah, you're absolutely right. This is exactly where a lot of folks are kind of using those types of products.
Interesting.
What about crypto? What do you think of crypto?
Yeah, so crypto, I would not, and this is me personally, I'm less interested in basically investing crypto by itself, right? Meaning without it. By the way, you'll start to see emergence. I think crypto options have just been introduced at the beginning of the year. In fact, you know what's fascinating? So the IBIT option went to the 5th most traded ETF option in this first 2 weeks.
Wow.
By the way, think about that in the context of SPY, QQQ, IWM. It went to number 5 in the first 2 weeks. That's how much people are actually trading options on IBIT. Now, what's interesting though, that if you look at the S&P market, most of it is the skew is basically meaning people are buying more puts than they are buying calls, right? In essence, like meaning that's priced higher. But in Bitcoin, it's more calls because everybody is gambling on the upside.
Oh,
right.
So it's almost like taking a little leverage, right?
Yeah. So this is why I'm like, hey, if everybody wants the upside, why not take the other side of this trade and start buying protection? Right, you can get extremely attractive levels of downside protection in Bitcoin as opposed to just investing in it naked. I think also it's extremely important to determine which type of crypto. I mean, there's a lot of crypto bros. I just bought a place in Miami. I always ask like, hey, who lives in this place, right? And by the way, this is a true statement. I literally asked the person at the front desk, who lives in this building in downtown Miami? There are like a lot of tech bros, finance bros, crypto bros, and OnlyFans. Right? And I was like, and sure enough, I met a lot of crypto guys and in the elevator. And they're investing in all these things. And I actually just recently, I heard about, you guys ever heard of Fartcoin?
What?
Fartcoin.
No.
Oh, I think I read about that somewhere. That's crazy.
I looked this up. Fartcoin, almost $2 billion in market cap.
What?
More higher than over 1,000 of the stocks in the Russell 2000. The market cap is larger than 1,000 companies in the Russell 2000. And it's called Fartcoin because it makes gas noises when you trade it.
Oh my God.
Right? Like, I don't know about you. The thing is people have to realize that I always find this interesting. I'm putting this in perspective. Like what? The S&P PE ratio is what? Right now 22, right? If I take the Mag 7, it's close to 30, correct? Like, I mean, it's really high. And then what ends up happening is people then model out the earnings growth, and they're like, this is, in some cases, there's a disconnect between fundamentals and actual price, right? You've probably heard this before. Well, the fundamentals of crypto is 0. It gives you no cash flow. The PE ratio is null, right? And the market cap of Bitcoin at one point was like, what? Like, I think trillion? And like, basically, it's a very big number. I believe it was like 2 trillion or something. It's something ridiculous, like 1.2 trillion or something like that, right? Or Fartcoin being at 2 billion. That's a disconnect of intrinsic value because the only value in which it is derived is how much the next person will pay for it, right? Think about it. That is what drives the value, but now I take a step back. Does that mean not to invest in it? No, because something like gold has been a great asset class for some time and throughout history because it is a store of value. Yeah. So on one hand, if you're taking it as a store of value and you want to store it, you should have some protection on it. Mm-hmm. The second component is what bringing you back is, remember what I said about volatility as an asset class and bringing that volatility. in some cases, if you are selling volatility, and by the way, the vol of Bitcoin is in some cases can be over 150%, right? 30-day vol. Whereas right now, I think the vol is somewhere around 50. Put that in perspective. The VIX is 15, right?
Mm-hmm.
I could write some cover calls and you could get like, 20%, 30% yield, and you can actually monetize that volatility while everybody else is going long volatility because they're buying what? Calls, right? In that trade. I want to be on the other side of that trade. I want to bring my clients to the other side of that trade. That's what excites me. Not saying I'm just going to go long MicroStrategy or I'm going to go long some other position. It is, how can I store value? If I'm storing value, I should protect it. Or how can I monetize the volatility and make it work for me? That's my own personal opinion when I think about crypto. And then just probably, creating Farcoin probably is not the best thing.
So you're actually excited about the opportunities for some options trading and option strategies around that volatile asset, I guess?
Yes.
Yeah.
In fact, our firm, in partnership with First Trust, is hoping to launch several of these types of things, and utilizing that as a way to invest in crypto.
Interesting.
Because I do think the volatility is very attractive as a way to monetize volatility and as a store of value. But if you're going to store value, you better protect your value. That's all. That's why I think. But as far as like, is it a get rich game? And just go long or leverage long. I'm unsure about that because the idea is that value is driven by how much the next person is willing to pay.
And then as far as before we leave product innovation or innovation in general, are you guys implementing AI already in your space and what you're doing? Or how do you see that affecting the industry when it comes to products or strategies and things that, that investors will be potentially using in the future?
Yeah, that's a great question. So I think AI is going to percolate throughout, like not just finance, but everything, right? There's a lot of things like now I can get an AI system to write a prospectus, right? And then I just edit it, right? So there's a lot of utilization that we see. We have not fully, let's say, implemented it in our trading systems yet. But like I tell everybody, every single one of my traders codes Python, right? Those are the types of people that really embrace this type. I always say it's easier to teach a coder finance than to teach a finance bro how to code, right? And so I love engineers. I love not to say I don't like finance bros and finance guys or finance sisters. Got to be fair on either one. But I find it better, at least in our shop, to basically find coders and teach them finance. And I know a lot of trading firms on Wall Street have taken this tack. In fact, some of the biggest trading houses typically are look for coders and teach them finance, which is fascinating.
Interesting enough, we just hired a trader that came from a large RIA that was doing a lot of option strategies for their clients. And so we want you to talk to him for us to just kind of get a gauge as to how to package what he's doing for us. But he's actually doing some coding on Python. I'm like, what?
Yeah.
What is that?
Yeah.
Anyway.
I mean, I thought that was a Python.
There you go, buddy. Jim, any other questions on products or innovation stuff?
Yeah. So Jeff, I'm curious, like I've read that a lot of people are kind of thinking that the reason why so much has gone into options and covered call type strategies because of the baby boomers, demographic changes. But I'm wondering if part of it is because there's large positions that they have and well, maybe not Intel, but Apple and Nvidia, some of these positions that over long periods of time, they're just too big. They have to protect it. Mm-hmm. I'm just curious what your thinking is. I know, you've had tremendous growth, and I look at some of your competitors that are, also doing cover to call strategy. There's just been a massive amount of money that's gone in there. And I guess the other question is like, how much is too much, right? I mean, are these things scalable? If someone's managing, $100 billion in a strategy, I mean, I do worry because I know there's a couple option strategies that are out there that blew up from a few years back that were, taking a little bit too much risk. But what do you think?
Yeah, so that's a great question. I'll cover it in two parts. Number one, in let's say for uh, as far as, is it the baby boomers? Is it like single stock hedging? I don't see that too much. Like, as far as from our shop, I can't speak for other people. Like, we
Yeah,
are seeing larger allocations, let's say, in people's broader portfolio with broad market indexes as opposed to single stock, right? I do think, though, that the boomers have two things. Number one is they need yield. They're retiring. They need cash flow to retire. So creating monetizing as a way of monetizing volatility and creating yield to basically as a source of income, especially as the Fed had depressed interest rates so low for so long,
sure.
right? That is a way to say, like, hey, there's another source of income for the boomers, so they can have cash flow and continue through retirement. The second thing is, think about, as you retire, you're not earning money anymore, right?
Yeah.
And you need to increase the protection on your nest egg. And that's why I think downside protections such as buffers have been so attractive. And so much so that we actually wrote a paper at our firm in the sense that, you know how target date funds, as you get older, I move from equity to fixed income. And if you look how that did in 2022, literally you were taking a retiree out of the frying pan into the fire, right?
Yeah.
And if we change the paradigm shift, is to say, instead of moving your client to fixed income, why don't I just increase your protection as you get older, right?
Makes
If you're
sense.
in your 30s, I give you a 10 buffer. When you get older, I put you to a 15. You get a little older,
Hmm.
20. And all the way to you're fully retired, I'm going to put you in 100% max buffer, right?
Yeah.
No downside. And let's say, like, hypothetically, let's say 7% upside cap. So as a paradigm shift, instead of doing that, why don't I just increase your protection as you get older?
Mhm.
Guaranteed, these options guaranteed by the clearing of the exchange. And like I said, and Jimmy, you've heard me say this, if the clearing of the exchanges were to fail, the best asset class at that point is spam, guns, and toilet paper, right? And if you're Diddy, it's a lifetime supply of baby wood. Right.
That's funny.
So,
So let me ask you a question about that. The increased options trading activity because of products like yours, does it make the market overall riskier or more volatile or less? I'm not an options expert at all. So
sure.
does it affect the volatility at all?
Yeah, so this is a great question. This kind of tacks onto what Jim was asking, is if you look at the listed market, right? The listed option market, that actually makes up like around no more than like 20 to 25% of what you see in the, let's say, the option market. Most of it is going out there over the counter, right? So essentially all you're seeing is the tip of the iceberg. And if you look at the options that are actually traded out there on the listed market, you're only seeing the tip of the iceberg. You're not seeing all of the OTC options that banks are trading with each other and all of that volatility going. And having worked at a bank, and this is a very kind of educational, like I would not have known this unless, working at a bank, is that you have a risk book, right? A lot of times people think that if you come to me and I'm on an option desk, sell side option desk, you want to buy, let's say, protection, or you want to buy a bunch of puts from me. Typically it's, I don't go out and go find someone that wants to sell puts. It's not like if you want to buy X strike on Apple, like it's almost impossible for me to find the exact person that will sell you that sitting in the middle. So what ends up happening is I have to take on that risk. So I will sell you that put, and then I'll do what's called delta hedging. So if you buy a put, then notice if I buy a put, if the underlying goes down, if S&P goes down, I lose money. So I'll start shorting S&P through a delta hedge, right? But the only part that I'm unable, let's say, to hedge is the volatility, meaning the volatility exposure of those underlying options. So think about this. If I'm at a bank, and this is just a simplistic example, right? This is not how the real world works, but it's a really good way to think about it, right? If you want to, if Jimmy wants to buy a lot of protection, and I'm at a bank and I sell him the protection, well, guess what? I'm short a bunch of puts, right? Meaning I sold him a bunch of puts. Now, that means I got to buy some puts somewhere else. Now, if you guys are familiar, you guys familiar with auto-callable structure notes?
Yeah.
So if you're not familiar, especially the listeners out there not familiar with auto-callables, a very simplistic way to say it is you get, let's say, S&P or something, you get a coupon, but if S&P goes down 30%, you're down 0. But if it goes down 31, you're down 31, right? Now think about that trade. That trade is a short put at 30, right? Meaning nothing happens. And then once it hits 30, you lose a bunch of money. What did you just do? You just shorted a bunch of puts, right? So when a bank, let's say, sells an auto callable, they're basically, the investor is shorting puts, but then the bank is bringing in what? The opposite side of the trade of buying protection. Does that make sense? That the investor, those two are opposites of each other. And think about this. A bank does both. Sells buffer notes or trades the options, also sells auto callables, and also sells those trades. So their risk book is constantly a supply and demand. If everybody's wanting buffers, my volatility book this way will tilt. And then what ends up happening is I'll take an auto callable note and I'll increase its yield. Because guess what? I need more of that to balance my book out, right? Going long and short volatility and making sure that volatility. So it's kind of like somebody keeps wanting to sell me Honda Civics. I got to go find somebody that will buy the Honda Civic. Instead of being a Honda Civic, it's volatility, right? That in both hands, I'll price one versus the other higher to balance that book out. So a lot of times I get that question and say, hey, is there a capacity issue? Actually, in both sides of the trade, both of them are going out and they're balancing each other out. The bank would just change the pricing to make one side of the seesaw have more demand, right? It's just supply and demand of volatility.
So before Jim asks you some markets questions, I'm assuming, I got a few more. I'm assuming that you're very bullish on option strategies coming out in more packaged products like ETFs, and that market share that you guys have grown to is going to continue to, for buffered products, et cetera, continue to grow, right? Is that right?
Yeah.
You're very bullish on that. And then, do you see like, what's the next thing that you got? Are you more, now that you have scale, are you more focused on new strategies or just maybe educating advisors and investors more so that people like us are more aware of what you're doing so that we can allocate our clients that fit that need?
I definitely would say both.
Yeah.
Meaning continue to educate. Like that is foundation of us and our partnership at First Trust is all about the education for the advisors, supporting our clients and getting them the education, the resources they need to make sure that, not only do they know how the sausage is made, but actually how to use these tools in their clients' portfolios today. We will never stop doing that. So that is always 100% of the focus. And then obviously also, creating new strategies, right? I think in the option space, it's not just yield, it's yield across monetizing volatility across different types of asset classes, providing protection across different things, right? And then also growth, right? That's been a new space that we've been coming into is how do I increase the performance on the upside utilizing options without, let's say, increasing your downside exposure. So there's a tremendous amount. Like I said in the beginning of this, we were just in the third inning of this, and we're really excited about, what is it that we can bring that we've seen a lot in the institutional space and democratize it and bring it to clients and inside their portfolios in a liquid form today.
Yeah, I've been using your guys' dual directional structured products for a while, and it's amazing how many advisors are just not aware of that. And I'm like, wow, it's a great opportunity for a lot of investors. Jim, you want to ask Jeff what he thinks about the markets?
Yeah, well, no, actually, I wanted to ask you about how can investors best be positioned if they're, like, for example, we have some different tactical models, and they are pretty much like green is we're all risk on, red is we're risk off, and then there's kind of one in the middle. But like I kind of think of this in terms of basketball when you're Let's just
By the
use
way,
the
I'm
Golden State
terrible
Warriors.
at basketball.
You like basketball analogies. So Golden State Warriors, it's Steph Curry. Well, it's too bad Clay is not still there, but let's say they're up 20 points, 30 points. I mean, they're just gonna keep launching it, right? So they're probably not going to play as much defense. From a market structure, when you have a period like 2017 where volatility is really, really low, and I think the VIX was at one point like 9.
9. Yeah, 9.
So I feel like in periods like that, where all signals are like, hey, volatility's low, the economy's doing good, the technicals are good, I feel like you could probably use options to get a little bit more juice.
That's right.
And I think I know that's what some firms like S&P are doing with some of these risk controlled indexes. When the risk is too low, then you need to add risk, right? Am I thinking about that the right way?
Yeah, that's right. So, that's the great thing about options is that they allow you to kind of express your own view and actually, whether it be downside protection or upside, to get to express that view in a very simplistic way without adding like other types of risks into the portfolio. So yes, absolutely. I think you're thinking about it correctly. I think in like periods like 2017, I always like to say that like don't discount protection even in really bull markets, because the best time to buy protection is when markets are at all-time highs. And that's essentially what we're seeing here. Like, you don't buy like life insurance after you die, right? You definitely like you want to buy the insurance before the event occurs, right? And so that's why I always tell people, like, the best time actually to buy protection is when markets are at all-time highs. And those are the times where it is least obvious, right? And here's the thing is like, you get paid to be wrong, in the sense of like, if you're wrong, you still have downside protection, but you still have upside growth. That's how I think when people are building their portfolios, that's how they need to think about it, is that like, you don't have to be super right, but you need to make sure you continue to participate in the majority of the gains, but you don't participate in a large chunk of the losses if the market were to kind of correct.
Well, that makes sense. And like the put options, the protection's probably a lot cheaper when no one wants it, right? When
That's right.
Things are doing really, really well, that you probably need to systematically have a disciplined way of looking at that to say, I want to buy it, rather than when everyone wants to buy it, right? When there's fires everywhere, that's not the time when you want to increase your fire insurance.
Well, I was looking at one of your ETFs recently, and I was actually very surprised at how well it did last year from a performance standpoint. I mean, almost as much as S&P 500, very close with downside protection. I was actually very surprised at that. But what do you think about the market right now? I mean, in terms of economy, what do you think is going to happen with S&P 500, Max 7? What's your view on those things in 2025?
Yeah, so as a disclaimer, I am not an economist or a market strategist in any way. So, however, as it's kind of like that commercial where it's like, I don't know anything, but I went to a Holiday Inn, right? I stayed at a Holiday Inn. Jim would appreciate this. I don't know anything, but I do teach CFA, so like, and so for me, I think a lot of what's driving kind of the market upwards, and it can continue to move, is productivity, right? Like total factor productivity. If you think about the overall economy, it's essentially three things, right? Productivity, labor, and capital, which kind of feeds that process. Now we have obviously probably in some cases like over injection, like too much capital, probably, and especially after COVID and so on and so forth, which is probably what's pushing up inflation, right? But what's keeping us is total factor productivity. Productivity continues to grow at higher than historical averages. And that has actually been much higher than what we've seen in other parts of the world, right? Because that type of growth is, you don't get dinged for from an inflationary perspective. I think if that starts to really pick up from, let's say, the efficiencies that we see with AI, I think we really start to run. But the key here is to be vigilant, because think about this. Think about the total factor productivity of the internet. You guys remember like late 90s, like the dot-com boom and everything, like, there was like Priceline.com that was crushing it. Think about all of the companies that were hot then, Netscape, AOL.
Mhm.
They don't exist today, right? In
Gone.
the early stages of the internet, it wasn't until later, like as the iPhone came out, that you start to see the big players, Uber, Netflix, right?
Google.
Google. They
Yeah.
came later. So all of these companies that everybody's looking at AI as the initial ones, I kind of look at them as like the Netscape and Priceline.coms of the late 90s. I can promise you there's very few things that I would say looking forward that I'm certain about is that the winners today will not be the winners 10 years from now, just like the internet, because the innovation will move so fast and no one can estimate who those winners necessarily will be per se, but it is to stay vigilant as far as, hey, that will drive total factor productivity forward, but that doesn't mean that, the winners today will continue. Is the Mag 7 continuously going to be the dominant players? Because you're going to see new interests. Like back in the day, Intel, AMD, those were the major chip. Now suddenly NVIDIA, but is NVIDIA going to be the one? I don't know, right? It's not, but that's like, if you look previously, like, they say history doesn't repeat itself, but it rhymes, right? Those are the things to stay vigilant when you look at, let's say, the stock market overall and how it relates to the overall economy as it pushes productivity forward. Now, with that said, though, if that starts to taper off, there are impacts of kind of the monetary policy that has come that could have some headwinds to the overall economy if productivity starts to slow, right? But which doesn't affect too much of the stock market per se. I actually think what's interesting is the impact of structural unemployment, right? Like in unemployment, you have cyclical unemployment, which everybody looks at. There's frictional unemployment. Nobody cares about that. It's just people like changing jobs or changing places, right? Then there's structural unemployment, meaning are the people where they need to be and do they have the skills for those jobs? Meaning there can be a tremendous amount of job openings, but they all require that you code Python, right?
Mhm.
Like people need to be retrained for the jobs of the future, right? Think about that. Like every day I go to the airport and I see that TSA guy looking at the screen and like checking my bag. I was like, an AI system can do that in 2 seconds.
Yeah.
The machine can learn that probably within hours and do it better than you without all the sass, right? Like that's what's interesting. But then what happens to that person? That person needs to be retrained, and you have structural unemployment on how to fill the jobs that are open that require different skills. That's where you can see a disconnect between the stock Wall Street and Main Street, which I think is kind of the structural unemployment that we may see in the next couple of years, is like people having to be retrained. I mean, have you guys seen those Wemo cars that like drive
Oh,
themselves?
just in Phoenix, it was crazy.
Yeah.
There's tons of them there. It's insane.
Yeah. I always like to pretend there's a person driving, like, hey, Mikey, what's up? Like talking to myself as I'm in there. But think about that. What they have, like truck
Yeah.
drivers, right?
Mhm.
Truck drivers, like one day that will be obsolete. The truck's going to drive itself from point A to point B. Take that all the way to the very, very end on what that means from a structural unemployment perspective. And
So that makes me think of I went to one of your conferences. I think it was before you were with First Trust, but I asked Brian Westbury about the whole technology and AI, and he talked about all the railroad workers and people that worked on the railroad and like all those jobs had to go somewhere else. So I mean, it's going to happen. It's probably going to be a little bit messy, but it's probably going to be beneficial for everyone, right?
Yes. So efficiency will, absolutely, will increase.
This next 10 years is going to be very interesting in regards to that. Were you going to say something, Jim?
Oh, no, I was just going to say with the markets, and especially as it relates to what you're doing with options, I feel like with AI and, assisted trading and better analysis, I feel like that might make the markets a little bit more stable. We're still going to have our bumps in the road, but maybe we're going to have more by the dip type mentality. I feel like we're seeing some of that now.
Absolutely.
Whereas, when we have a little bit of a sell off, then, money comes back in and people get more comfortable. Maybe they get more confident. I don't know.
Yeah.
We're still going to have crises, but maybe it's not as crazy as like many years ago. We had Peter Tuchman on last episode, and he talked about the crash of '87 and how bad that was. I
Yeah.
feel like those days are probably largely behind us. What do you think?
Yeah, it's hard to say. Like I'm a wounded person after experiencing '08 and 2010 and COVID as well. So I having been in finance as a Gen Xer. By the way, like I think we're all Gen Xers. Like X gonna give it to you, right? Like we're not the Boomers and we're not the Gen Zers. I always tell my employees, I'm like, hey, I grew up with the rotary phone, like da one, two. And then what? And I was like showing them what a slide rule was, and they're like, "What is this garbage?" Right? But I think, and by the way, the people out there see me like I'm only 25.
By the way, I like it. I think you've got like you're inside of a jacket and a beach towel. I mean, your image is all over the place, right?
Yeah, that scares me all the time. Just the idea of being on a beach towel and someone's gonna wipe themselves with my face is a scary thought, right? I'm gonna make a beach towel Jimmy Lee, so that way it'd be like,
Oh, there you
The first
go.
thing I saw that was one of your wholesaler guys had your image inside the jacket lining of his jacket. I thought that was so cool.
The suit jacket. Yeah.
Yeah,
You got a lot of fans out there. I don't know if you're going to finish that
it's just
topic,
getting,
but one of the things I wanted to ask you was on options trading, doing it for so long, does it tell you sometimes things about the market, in terms of just what the kind of activity that you're seeing there and maybe the premiums being high or low, and obviously that,
absolutely.
but do you see stuff after doing it for so long?
So the Bitcoin vol skew is a great example. Like, hey, like everybody's buying calls, it's skewing to the top side, right? Whereas like a normalized market, like those are definitely things like kind of tells you sentiment, right? And so where people are really investing in kind of the overall sentiment of the market. So absolutely, yeah, you can actually gauge a lot of where kind of the overall market may be through signals in the option market as well. So that is in fact that some I say technical traders have utilized those as signals to buy or sell.
So Jeff, I want to ask you one last thing. We're up on about an hour or so. We should be wrapping up here soon, probably. But
so soon? I thought we could go like another hour. I haven't finished all my jokes yet.
Right.
We'll go as long as you want, my man. Good. Jim and I, we're on West Coast time at the moment.
We're game.
What do you?
You guys are probably like, can't wait to get this guy off. Like he's a liability.
What do you see yourself doing outside of finance? What are you thinking? I think I'm going to be a financial advisor until I'm in my mid 60s, probably. So, but I do have other interests besides this industry, and I've always thought I would do something post 50 years old. But how about you? What other interests do you think you might be involved in potentially outside of this business, either now or when you retire or whatever?
So since Jim mentioned it, I want to be a professional basketball player.
Here are the jokes.
I love it.
By the way, do you know, and folks out there is a Disney movie called Chang Can Dunk. You can Google
I love it.
By the way, it's my life story, right? Chang Can Dunk.
Are you a baller? You play hoops?
No, I'm terrible at basketball. By the way, the things I'm really terrible at playing basketball. I'm really bad at cooking, and then planning gender reveal parties.
That's all it is.
So the only thing I'm good at is basically options and making people laugh. So to answer your question, my dream is when I'm done here is to do stand-up comedy full time.
Really?
Like that is my dream. In the past, I do it as much as I can on the side. I opened for Ray Romano once.
Come on.
It's just I want the shackles off where I could just say anything on stage I love it. Kind of.
I love it too.
It's been I think I took a stand-up comedy course back in my 20s, and I would say this is a piece of advice for everybody out there. The best public speaking course I've ever taken was a stand-up comedy course. The reason why, it is the only public speaking course in which you have to elicit a reaction from the audience, not just go up there and speak. Like, you actually have to engage, and you have to own the audience, and you have to control the room. Like, that is fascinating to me. I never thought about that when I was in my kind of early 20s. What does it mean to be a good public speaker? It means to really reach every single person in the room and get that reaction in there. And I love that, because that connection, that ability to make people laugh is just something special. And I think if you combine that with, helping your clients make money, that's a dream come true. Right.
Yeah. Awesome. I will say this. Some wholesaler friends of mine who I love at First Trust were telling me about your products. And then I'm like, whatever. And then I went and saw you at the meeting, and I'm like, wait a minute, why don't you guys tell me about this? Including laughing a lot. So that's a fun one. Boy, I can't wait to see that. What was I going to say? You did the jokes work well in the Naval Academy?
No. By the way, that kind of normalized me a little bit, right?
Yeah.
Like, otherwise I'd totally be like unstable. I needed a little bit more discipline when I was coming out of high school.
So how about teaching CFA candidates? Did you tell jokes to them too, like in the videos? People are
Totally. By the way, if you're doing like a 3-day review
accounting,
course, 8 hours a day, you gotta tell some
corporate
jokes.
accounting.
Yeah. You're teaching accounting. You gotta tell some. You gotta tell some jokes. Otherwise, like, you're gonna get. Everybody's gonna fall asleep, right?
And Jeff, where did you grow up?
I grew up outside of Annapolis, Maryland.
Okay.
That's hence why. That is. But I still won a math competition in China when I was 5.
Really? Wow.
No, I'm just kidding. That was from The Big Short. By the way, The Big Short, I thought that movie was about me. Get it?
That's what it is. I gotcha.
Big Short.
He's practicing on us for his.
That's awesome. So Jeff, do you speak Chinese?
I do.
A little bit.
Yeah. I mean,
so I took Chinese 27 years ago in college, and now I'm just starting to like brush up on it again. So I'm doing Duolingo.
Yeah.
I'm still pretty far from where I want to be.
Jim Jim did his mission in the Philippines. He can speak Tagalog. He's pretty good.
Really?
I can speak Tagalog.
Can you tell jokes in Tagalog, Jim?
I can.
Oh, all right. Well,
what am I doing now? I probably don't have time, but
that's funny. All right. So in summary, everybody, the option strategies, the buffered products that Jeff has in a lot of ETFs and other strategies are very popular. They've grown a lot. Going to continue to grow a lot. Advisors need to get more educated on the subject, including our own. So thank you very much for sharing the time. And ever since I got to meet you not too long ago, I feel like there's a kindred spirits, and I'm a big Chang fan. So I'm
a big Jim and Jimmy Lee fan.
I love it.
Unfortunately, Jim Warden, I can't pretend to be you. Nobody will believe you. But Jimmy Lee, on the other hand, I fooled some people. Like, I remember, like, there were some wholesalers that tried to sell me some stuff when I had your badge on. I'm like, you're going to have to talk to my boy, Jim.
Wrong one.
No, it's not me.
Here's Three's Company too. Come and dance on our floor. Take a step that is